taking a look at the gold chart, what we have here is a classic parallel, right? High pivot, low pivot, low pivot. We connect them and we get this beautiful parallel. Then we have this inside parallel, which again, this parallel is parallel to these lines here as well. And it continues to keep price in check. And so you can see today, gold is down a little bit. If we look at the last few days, last week, gold was up a little bit right here and then came down. So really, amazingly, since the 15th of May, gold has almost not done a thing. Now, that's actually a technical intrigue. And I'm going to tell you why here, guys. So if we go back to the chart, I want to throw on my 50 daily moving average and my 200 daily moving average. Here's your 200 daily moving average. Now look at this. So what we see here is that when we got this secondary bigger pullback and we came to the lower end of the parallel here, it was also the daily 200 moving average. In addition, look at what we just tagged over here on this last little dip. And so essentially the bottom of the gold trade right now is being held up by the daily 200 moving average. Now, the reason that's important is that if the daily 200 moving average gets breached, then the lower parallel here will get breached, and you'll likely see that bigger dip to the downside. Minimum downside would be a retest of 4,100, this low pivot right here, but potentially even down to this lower parallel trend line, which would be a major corrective move on gold. Now, again, you'd say, okay, well, that's the lower end. What about up here? What else is up here? And I want to show you this because it is so cool. At least to me, it gets me all excited. Look at this. Here's the daily 50 moving average. And what we have here is look at how we hit the daily 50 moving average here, the daily 50 moving average here, and right here is also the daily 50 moving average. So what are we seeing here? We're seeing that you have parallels, but you're also being sandwiched between, on gold, the daily 50 moving average and the 200. Now, why is that important? Well, it's important because it gives us a secondary factor when price breaks one way or the other. And keep in mind, these two trend lines, these two moving averages are getting closer and closer. Essentially, they're wedge patterning. And again, for me, and by the way, wedge patterning is a technical term. No, not really. But the essentials of this are that a wedge pattern, all right, I'm just going to draw a general wedge pattern, keeps price. It condenses price tighter and tighter and tighter until it either breaks out in a major way or breaks down in a major way, right? It's essentially sandwiching or pressurizing the price action. And you can see it sloping up and sloping down. And so what this tells me is that probably within a couple weeks, maybe less, we are going to either get a major breakout on gold or a major breakdown. Now, again, some of you will say, all right, so it'll go up or it'll go down. Look at what I'm saying. What I'm saying is you're going to be able to tell by this chart which way the major move is coming. Price is going to get closer and closer and closer to those two trend lines, the moving averages. When it breaks, boom, that's the trick. Now, silver, let's throw on those moving averages just out of curiosity. Now, silver here, so we see the 200 moving average right down here. All right, so here's your 200 MA. So notice how this isn't really close to price. Okay, you've never actually hit it. Even over here, you didn't hit it. But look at how price is hugging the 50 moving average. But if we look at the chart pattern, is this bullish or bearish? Well, look at this. Let's get rid of the moving averages. What type of pattern is this? We've broken this upsloping trend line on silver. So down move breaks. And what type of pattern is this? All right, if you have a down move and an inside bar pattern, you guys can be answering this right now. I'm sure some of you guys are. That's an inside bar bear flag. It insinuates price is going to drop, which kind of makes sense, right? Because if we're hugging the 50 MA, but we haven't hit the 200 yet, and the 200 moving average is down here, which is my next major support, it implies we should see a leg down on silver to about 66 to 64. At that point, that will be the big test on silver. That is cool, guys. That is really, really cool stuff. All right. So again, keeping an eye on that, and we'll watch and continue to monitor how that goes. I do want to quickly go to copper here. Let's go over to copper real quick. Take away the moving average for the time being. Copper's actually having a little bit of an up move today. But again, this is the concern, is you have this bigger parallel, which is going to mean major resistance around 670. And we still have what we would call an inside bar pattern here, which again, generally leads to the downside. Now, listen, if copper can break this level, okay, then we're talking something different, right? That would be a breakout. It would be a negation of the bear flag pattern. But until that happens, game on. This would be a bearish inside bar, meaning probability favors the downside. The other thing to watch here is you have a very defined break point, right? So watch for this. If you want to see a trigger, right? So some people like to trade the breaks of lines. Here, this would be a break up here. This would be a break down here. If you come down and you break here, you're probably going much, 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 much lower on the copper price.
We own, I want to preface that by saying we own gold bullion, a number of gold miners, royalty companies, a tiny bit of silver. But what happened last year, the last 2 weeks of the year and the first week of the new year, we cut back we took some profit. We didn't get out. We took profits in some of the gold miners. We sold completely out of silver when it went at 100 or above, and we just cut them back, because they were real expensive. Gold went to 5,500. And what happened is you've had that last 3 or 4 months of last year, you had a lot of what I call momentum money that started chasing gold and silver. And they didn't really think about price. They just wanted to buy it. And they ran the miners up the same way. So we took some out and felt like we would go through a 6 or 8 month period where they'd have to digest that, probably sell back, and you'd have to go low enough to get rid of those momentum players. Now, we're in the process of it, but it wouldn't surprise me for us to go a little lower on gold, but we'll add them back at some point in time. Because I think if you were to ever break now to 4,000 or 3,800 or something like that, I think you'd take your momentum players in the gold area, the miners. I think they'd be gone. And that's probably a spot right there where you'd really want to increase your gold and your miner ownership. Now, that may not happen. If it doesn't, we still own them and still own gold. We didn't sell hardly any of the gold bullion. We keep it, but we sold, cut back on the miners, cut the silver, and you'll see us add back. If we get a chance, we'll add them back here, and may add them back anyway, but I'd like to see what we're going to get here in this consolidation. One of the things happens, there's two or three things happening here. A couple of central banks had to sell gold for liquidity in this whole Straits of Hormuz deal. A couple of those central banks sold some gold to raise money. I don't think it'll last, but that happened. Secondly, a number of your gold buyers, if rates go up, they tend to back out of the market. They've seen it before where rates go up a lot and gold won't follow like it normally. But it catches up though. Here's the point. It came way off in 08, and it was one of the last things to go down in 08 and early 01. One of the very last things. They usually get in a bear market, they'll get around to everything eventually, and they did. But there again, it was back at a new high, a year later. So I think we're similar to that now. You just have to see how far this consolidation goes. If I didn't own any of it and I were somebody, sure, I'd buy some, but we own them.
Take a look at this. Here was a wedge pattern. Let me get rid of the moving averages here so we don't need them on the chart here. Here was a classic wedge pattern. Look, it broke and you literally went from $98 to $99 all the way down to 86. All right, over 10% move right there. Now you're getting a bounce today, but my guess is this is a bounce before we eventually go lower. So in other words, big moves come when you break from wedge patterns. And in this case, it's not just a wedge being created by the moving averages. It's also the parallels. You have double factors that when it breaks, it should be even more explosive. Now, again, in general, because gold has been moving and silver has been moving as a risk on, risk off asset, I would be a little nervous that, at some point the stock market, which again is at all-time highs today, is going to have a pullback. And do we see gold then pull back, or does gold go back to being a, risk off play like what it used to be prior to the last 6 months, essentially?
Oil and natural gas. Natural gas we think it's right in there with oil. But there again, you have to look at where there's going to be shortages in general. Copper, to a degree, iron, a lot of the critical minerals. We own tungsten. We own a number of fertilizer companies. And so we have sort of across the board. We own a couple of agricultural companies because in inflationary periods, and we feel like that's another reason we own so much fertilizer. All those things work really well in those kinds of periods. But yeah, we own a little bit of a lot of those things. They paid off well for us last year, and so far this year, really, if you want to know. IEA, well, I feel like they've made some very, very poor predictions about oil, and they're usually not. They're not usually don't come true. So we don't use their stuff at all. But we felt like that oil was not near as there was not near as much oil in late 24 and 25, early 25 that people thought there was. And you know that's another reason I own stock. If you know more than the other person, then you're probably going to do okay. We pulled a lot of oil out of the system now, and we got to supply all the strategic supplies in all these countries, not just the U.S. That has to go back in. You know, I mean, there's a lot of reasons for it, but we feel like the rest of the year will be a good year for them. And you know, maybe that's wrong. I don't know, but that's what makes a horse race, Anthony. We haven't owned any long bonds in a long time. I'm talking about 6 or 7 years. I mean, at the end of that, at that low in 2020, at that low, the 10-year was half a point or whatever it was. I mean, it was over. And now since that time, we've run these huge deficits. But we said all along to people, you can't own 20. We really don't feel, I mean, you can if you want to, but I'm just saying it doesn't make a smart move to own 20 and 30-year U.S. Treasury. And the reason it doesn't is because you're swimming against the tide. You got, you know, rates up, inflation up, and if